Well, good weekend all. Ira Epstein and I am back. So here we are, just got back, in fact, from beautiful Montana. Loved it, obviously. Got a little color, had a great time still in my t-shirts and had just a wonderful time. But while I was gone, an awful lot has happened, obviously. We're through with tariffs, so we know where we're at. Countries can come back to the president and negotiate them lower. They can also find they're higher if they do the wrong things and irritate President Trump. You will see that if something goes wrong. While I was gone, the clock has been ticking down on Russia. India is already standing defiant and says it will buy oil from whoever it desires to buy oil. So they'll get hit with something else should they do that and test the president. There's just a lot like that. And then, of course, we saw the unemployment report on Friday, and that report was full of corrections. Now, the president's blowing this up like, oh, this woman didn't do her job and so on, or a man, I think it's a woman. It doesn't matter. There's always corrections. Did everybody forget that in March they make the big corrections of the year? But every time you get one of these reports, you get corrections. So because they politically didn't fit in for the president, he's apparently butted this woman out. He'll put somebody else in. But you can only report the data from what you collect. If it's collected poorly, you're going to have poor results. If it's corrected accurately, you'll have a better result. You know, it's pretty simple. What is important is the jobs part of the market has gotten a chink in it. And as that chink has happened and you're getting a little bit of a rise as the unemployment, and since inflation so far is under control, it opens the door to think that maybe the Fed can go in September if they get another jobs report that is just as poor as this one that came out. I think that's the way you look at it. Obviously, we'll be looking this month at CPI, PPI, the PCE reports, get inflation readings, because so far we haven't seen it. And what nobody's really talking enough about is these inflation numbers that you'll get via this report, via the tariffs. The important thing is these tariffs aren't as bad as they could have been. They are for Switzerland. They are for Brazil. All right, but for other countries, they're not. You know that as much as you hear that we've got a 35% tariff or what on Canada, it's only certain goods. There's goods that have been carved out. There's the USMCA goods. So it's a small amount that is left. Other trading partner, Mexico, working on that. So there's some parts that we'll see. But again, the tariffs are set as they are, and they're not earth-shattering. That's the way to look at it. So what happened to the market? Well, correction, and we'll get to that in 1 minute. Why don't we first take a look and understand we're going to get factory data orders for June. They're going to come out at 9. They're looking for them down 4.6%. In May, they were up 8.2. The rig count fell again from Baker Hughes down to, we had one set recently that were up about 7, but they've been giving back steadily from that. I was watching an interview on vacation from the head of Chevron and listening to what he was saying and how much they're producing and how they've insulated their business no matter what pretty much happens. So the oil boys aren't scared, and hanging their $70 in Brent isn't enough to scare off the Saudis either. Remember that. So there's a lot coming. Russia's the one that has to worry because the U.S. can dent the sales they make if countries get scared of the Trump tariffs, that he'll threaten on them and will put sanctions on the money out of the SWIFT system. Well, China doesn't need to do it that way. India could probably get around it as well. There's different things that they can all do. All right. So, as I said, when you take a look at the markets, once the tariffs were all known, it's like the market did this. That's it. And a correction hit in the market rather hard. And it first held up, but then it all gave ground. So maybe we should just go to the charts and let the charts do the talking for us. I had been talking about toast and I left on vacation, so I'm just going to pick up where it was. Number one, I like this company because I believe that the future is whenever you go to a restaurant, the waiter doesn't have to run somewhere. They can enter the order right on the system in front of you. In addition, they should be able to give you a check right then and there. It just makes so much sense, and this is where this is all headed. And I don't know that there's other serious competition with market share, and that's why I think this company has been moving up and away. When we look at a weekly bar chart, you can see the market's been climbing. When we look at the reaction on swing line, you have a higher, you've got right here the higher high, but you have a lower low. So when I look at the market, the lower low is what's in place, and this correction that it seems to have set up this past week, the question is, does it have any legs to it? If it does, possibly it goes back to wherever the 18-week average is, which is 41.22. If you, by the way, should take out the highs of this week, I think you'll go right to wherever that upper Bollinger Band is. In addition, you have an embedded reading. So I'm viewing the breaks in the market until the red line closes under 79 is ideally being shallow in nature. You're coming off a new high for the stock. I'll be looking at this off the daily chart. In Netflix, on a weekly chart, this is where I think the support should finally start to show up. The 18-week average of closes, you got to 1152.85. That average is 1157.13. It could go back and forth here, but I think you're at the zone. If I'm totally wrong in my thinking, you could be going back to the Bollinger end. That seems to me an awful lot to ask. The earnings report was good, not bad. It's that the market was at 47 times earnings, way ahead of itself. You hit the Bollinger Band on that last week and you fell back on Starbucks. But in Starbucks, you worked your way all the way up. I think the market exhausted itself as it hit that number, and now it has to rebuild the chart, in my opinion. Eli Lilly just can't get out of its own way against this 18 and 100-day average. If we remove this and you look a little bit as to how this has gone over the past couple of weeks, 2 weeks ago, this is what you looked like. The market tried last week, not the week we just left, 2 weeks ago, to say, I can get over that number and stay above it. And then, let me get there, and then it completely failed. It made the higher high this week and gave it up. So all that was for naught. Now the market just got to rebuild itself completely. I see zero to do on a weekly chart in it. Home Depot came alive. It got up 4 weeks ago, 5 weeks ago to the upper band, fell back to the 18-week average and came up again. On a weekly basis, this is in an uptrend. Strong support for the moment at 362.02 to 363.88, the combination of the 100-week average and in red, the 18-week average of closes with resistance at the Bollinger Band. In Uber, I think I've been very vocal for a long time. I don't think they should have bought into Lucid and the other things that they did. It just doesn't make sense to me. Why compete with those companies? I guess they're saying they should be everything to everybody, but then you stop people from wanting to use you. I mean, where's the incentive for Tesla to say you're going to use it? And I know you'll say, well, they were going their own route anyways. We've seen many of these where people say they're going their own route, and at the end of the day, it just doesn't work. Everybody uses Uber. Not everybody gets a Tesla app. You have to get it. Number two, you have to prove that you're going to use it. Got it? I'm not saying you won't, but I'd say Uber will compete with it pretty well in other ways. In any case, I'm going to look to see what it does at the 18-week average of closes. In Dash, this is good action in Dash. I mean, you have an embedded reading. You continue to make higher highs, higher lows. I think the pros will continue to buy it as long as it stays embedded. Lose that, I think they'll bail, but until that, I think they stay. XLI, you made the highest high of the whole move, and now you're giving something up. A number of these charts are going to be tested. Can they keep their bullish embedded readings? Those that can make it this week are in very good stead, in my opinion. So we'll see. Remember, the reason I say that is everything got hit on Friday. When you look at XLE, even it got hit. And notice where it's having trouble. The 100-week average with the support coming in at the 18-week average. It is an overbought market. When we come to the dollar, a heck of a rally in this market. I don't think it's going anywhere too far at this point. I think it'll have trouble getting over the upper Bollinger Band. Now, there's two ways to look at this. You can say that until these lows are taken out on UUP, you have a bottom. and the pros are likely going to buy the market at the 27.43 with stops under the lowest of these lows. It'd be about 70 cents, looking to see can it gradually in time go up. Another way is if it takes out those lows, then I think you've got another leg to the downside. So I think you're at a crucial point here. The gold has to prove itself this week. Look at all the sideways action. This is causing the Bollinger Bands, which will narrow in again come the opening on Monday morning, to narrow in a bit more. So we'll see what that does. In the copper, if you really study what copper did, you're within 2 cents from the low. Remember when the market took off, when the president put on the copper tariff of 50% to now taking it off? Low to low, you're within cents of each other. So all that's happened is the market got back to what I'll call normal. It's lost the bullish embedded reading. I can make an argument of 41.12, 40.83 should be the support zone. It's about $1.50 lower. And that's what I'm seeing right there. Sorry about that. You know, the way to keep up with me this week, and I am going to have a heck of a lot to say, is in my research. And via my research, I'm going to start. First of all, I will do a special report this week. I'm going to add some new features that we have for different things that we do. One of them is going to be right in like a mailbag to me. And in there, I will start answering in my videos for subscribers questions that they might have. So it's a new feature I'm going to bring on. Just go to iraepstein.com research. You can sign up for any of the research, the spider ETFs, the futures, the combination. Whatever you decide, do it all right there. And I'm Ira Epstein.